Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Monday expert, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. How are you?
I'm doing well, man. Thank you for being a part of this channel for all this time. I look forward to our conversations, and our conversations are very different than my other experts, right? You are an entrepreneur at heart. You are dancing through raindrops. So I really appreciate you giving us some time.
Doing my best.
Thanks, buddy. Hey, so something I've been thinking about kind of a lot over the weekend is I'm going to make a kind of what I think is going to happen in the stock market. And I'm talking about at the index level, right? Dow, S&P, NASDAQ. And I just want to throw it out there. And first off, people realize I am not talking my book. I have exactly $0 in the stock market. I will have exactly $0 in the stock market at the end of the year. So take that off the table. But what I am,
what if we get a nice correction?
Yeah. Well, I tell you this much. If the stock market falls 50%, I will go shopping. That is my threshold. But what I think is going to happen by the end of the year is we will see at least a 15% correction in all of the indexes, peak to trough. And I don't think people are ready for it. I think it's fairly certain, just given the tea leaves that I see. And again, I could be entirely wrong, but that's why I wanted to ask a guy like you who looks at the market at least as much as I do. So what do you think? I tell you the stock market's going to fall 15%. Do you go, he's crazy? Or, what do you think? What's your first reaction?
No, I mean, I wouldn't call it a crash. That's a correction, 10, 15%. In this day and age, with the levels that we're at, even 20% could be considered a correction, depending on how it happens. And we're seeing it happen right now, and it's sneaky. It sneaks up on you because we call it profit taking. So this week is a week of profit taking. So you're going to see, like right now, we're down probably 1.5%, 2%.
Oh, wow.
The numbers look big in terms of the amount. Yeah. Like right this second, we're probably down.
I haven't even looked.
Yeah. 300, almost 400 points. It was down 500 a minute ago, but that's only 1%, right?
Right.
So the points look big, but the percentages are small. And if you look at the last week and look at where we're at now, the market has rolled over, and now we're on the downside. And, it's 2% here, 1% there. Then it bounces the next day, 0.5%, so it's kind of works its way over without you realizing it. Next thing you know, you're down 10%. So that's not really a crash. A crash is an abrupt drop like we saw March of 2020 during the pandemic. That was a crash.
Fair. Okay.
We lost, 40, 50%. And then we quickly recovered because the Fed stepped in. So
the Fed jumped in and said, I'm buying everything.
Yeah. So I absolutely expect, and we are in the process of a probably 15 to 20% correction right now.
Okay, cool. Well, let's talk about that more. Again, things that we see. So the rollover, I totally get. I think there's other tea leaves that I see happening that I don't think people expect. First and foremost, what I expect to be happening is more and more people, quote unquote, go back to work. And I don't mean like from unemployment to employed. Well, there'll be some of that. I actually mean from working from home to working in the office. I think a lot of the retail trade that's been going on, and these are record high numbers, kind of reverses as people go back to the office. I think the buy the dip crowd who was using money that they didn't need, right? The stimulus checks, right? People that were employed, that were spending less and saving more, didn't need the stimulus, but got it anyway. I think a lot of the buy the dip crowd is cooling off. Right? The volumes on down days is much less than they were at other periods. But I think the biggest thing that people don't see coming is for the last 12 months, 81% of the S&P 500 reported an earnings surprise, right? Either top line or bottom line or both. I believe we are going to enter a 30 to 45 day period where half the earnings are negative, right? They miss on something, or maybe they hit, but they lower expectations. I think we're in for a pretty nasty earnings season, frankly.
Yeah, numbers are tricky. So companies obviously have become a little bit more profitable that stayed in business and thrived through the pandemic because, staffing levels were cut, number one. Number two, prices have gone up exponentially. So that's going to increase your top line. And, Wall Street looks a lot at top line and, they look a little bit at bottom line, but that can be manipulated with, carry forwards and things like that. So
for sure.
So it's interesting times right now, but yeah, a lot of companies been booming. We saw a lot of, retail spending increase because people aren't traveling globally, things like that. So a lot of money was spent in country versus outside the United States, which really affects, earnings, right?
Yeah.
Earnings season. And, I think we're going to continue to see that through the end of the year because people are going to spend on Halloween, Thanksgiving, Christmas.
Mhm.
We are now open. People are back to football games, things
Yeah.
like that. So there's a lot of revenue coming back into, travel and entertainment in the United States that
Mhm.
wasn't there last year. Hotel rooms, things like that are up, summer
Yep.
vacations, things like that. So I think as people get back out more and more, you're going to see probably, earnings, but at the same token, the market's it's rolling over. So
Yeah.
um,
I think the big thing that's going to roll over, at least, again, one guy's opinion who's got nothing in the market, is the price to earnings ratio, right? At some point, I think Warren Buffett said it one time, one of his many famous quotes, right? There are times where the market's kind of like I don't know what he called it, like a voting machine, but most of the time it should be a weighing machine, right? These meme stocks are the best example, right? When everybody gets behind something like a Reddit trade, it's going to shoot to the moon, right? Because it's supply and demand, and God, heaven forbid you're shorting that when the Reddit trade comes. But at some point, just like we saw in the .com era, price to earnings ratio makes sense. Losing money quarter in, quarter out is not a good idea always. So I really see these stretched PEs that are at record highs coming in, especially into an environment where actually I think the bottom line is going to be important because, yeah, the top line is going to go up. But I think there's so many companies, Pepsi, General Mills. I mean, everybody's reporting higher input costs and shipping costs, like Frito-Lay. I think Pepsi reports tomorrow. And I'm so nervous for Frito-Lay, right? It's a chip company. They make chips. And chips are really light, but they're also very bulky, right? So you can only ship so many.
And here's what I've noticed, and I don't know if people watching have noticed, but it seems like what you're getting is smaller. The bag size is the same, but the quantity inside of it is smaller.
Shrinkflation.
And shrinkflation, so it's really interesting. But, the fundamentals are out the door. And when you look at PE ratios and valuations, the conversation now on Wall Street is, well, when you adjust for interest rates and the liquidity in the market, well, the valuations make sense. So that's how they're justifying it, because of the activity from the Fed. And what you're seeing now is people know the Fed, they have to act. Inflation's real. It's not transitory.
Yeah.
What they didn't count on was, wage increases because people do not want to get back in the workforce. There's, a lot of people that don't want to go back to work because of the pandemic. They don't want to get vaccinated. They're not going to adhere to the, mandatory vaccinations and, things like that. So, when we did that last video, there were some comments that people were like, I'm not going back to work. I refuse to get a vaccine. So, that's keeping a lot of people out of the workforce, as well as people have adopted and adapted, like you said, into trading and other means of making money where they've realized I don't need to have a job. I can earn money doing this, doing that, trading, whatever it is, which I think is awesome. I mean, I'm an entrepreneur, so I'm all about carving your own path, but the Fed did not foresee that at all.
No,
they totally missed that one completely. And, now, their job is full employment, right? And they can't get people to go back to work, even with record high, wages and incentives and things like that.
Really number of jobs. I think the last number I saw was there's 9.5 million people unemployed and there's 11 million jobs. Right. And we're not saying they're the right jobs in the right location. It's just top line numbers. It's never been this way.
It's a fascinating time in the country. And I think you're still going to see that pressure continue through the end of the year. I think, probably after the holiday hangover and tax season sets in, they're not going to have any choice. People are going to have to go back to work, because savings is only going to take you so far, and markets are going to pair off a little bit, and, we'll see how the year ends. But we had a bet, about raising rates, whether it's going to happen this year or next year. And I still think they might have to do something potentially this year, depending on how bad inflation gets. But you're definitely going to see the taper start this year.
No question. The taper starts. The question now is, does it start December and November? I think they're talking December, and I think you're right. It could start November. I see no chance that they have a raise this year, but I think they'll have a raise as early as March next year. Right. That's kind of where I'm at. I actually want to ask you, because I actually put out a thought the other day that my spidey senses were getting actually pretty nervous about an unexpected recession. Think about that, right? You have rising inflation, and you actually have a poor economy, stagflation, a la the 70s. But I want to ask you about Q3, because what I'm seeing Q3 expectations, which we just finished, I want to ask you if you think this is would be counted as a negative growth quarter. People are saying that they expect inflation at 5%, but GDP growth at 4%. So if you're just a strict economist, you would say GDP growth of 4% doesn't count. I like to look at kind of the net. And if there's growth of 4%, but inflation is 5%, I actually call that a negative print and would consider that to be the first quarter of what is required 2 quarters to be called a recession. What do you think?
Yeah, I mean, I suppose it could be, negative growth is, what they're using for that benchmark. So yeah, I mean, that's definitely a negative growth.
So you would count that, right? Again, 4% print. Most of the I don't know, the talking heads on TV, yay, 4%. But when you subtract a 5% inflation, that's negative. That real numbers, that's negative in my opinion.
It is, but they're not going to measure it that way. They're
No,
just
of course
gonna
not.
look at the growth.
No, they're gonna say everything's okay, people. Don't worry, 4% growth. We're the U.S. economy. Don't worry. And I'm like, I don't think so. That's a bad quarter, right? So
yeah, it's like interest rates. I mean, we're effectively already at negative rates when
exactly.
you factor inflation.
Yeah, so that's, again, people are weird. It's like, why are you going to go borrow money on a free and clear asset? I'm like, well, let's see, folks. I can borrow at 4%. I think real inflation is 8%. Why wouldn't I? Right. And yeah. I can go get a nice return on my money. I mean, I'd be silly. Yeah.
That's why markets are up, cryptos, stock markets, things like that, because you can't get yield anywhere else. So you put it into risk assets. It's the only yield out there until it isn't. And, the bond market is rallying a little bit. So, the bond market's anticipating something. Stock markets are anticipating something. A lot of things are baked in. And right now we're baking into the markets these things that we're talking about, which is good. The markets need a healthy correction. There's too much liquidity out there. It needs to, get removed from the markets and balanced out a little bit. But, we'll see what happens. And as we saw back in March, anything can happen, but we know the Fed's just going to jump in and pump it back up again.
Yeah. So again, to close this out, if I called a 15% peak to trough by the end of the year, 12/31/21, you'd be, yeah, that's possible.
I think we're already on the way.
There we go. Very cool. How can people find you and get part of your world? You have an amazing YouTube channel, by the way.
Yeah. It's gregdickerson.com. All my info is there. And that's where you can find YouTube, podcast, all that good stuff. And, I'm a bull, by the way. I think, stock market's been straight up since 2009, but you're going to have these corrections along the way. And if you look at a chart of the Dow, that's what you get. It's this steady trending up, but you get these little valleys as it goes along. As with all assets across the board, real estate, stocks, bonds, commodity, everything.
Since we talked about this early episode, my thoughts, how low would the stock market, generally speaking, have to go before Greg Dickerson gets excited?
Oh, back to March again, so I look for those big crashes, I'm back in on the big crashes. I'm not a long-term stock investor.
You're in and out.
Yeah. I mean, I'm everything, because I have better things to do with the cash, from a velocity of cash flow standpoint. So for me, leaving something in the markets long-term isn't as good as what I can do getting in and out of other things.
Nice. Very cool. Thank you very much for this. I look forward to episode number 2. Thank you.